David Roach, Quantum Economics and Independent Strategy. This tape should really be called Mea Culpa. As you know, Mea Culpa, Mea Culpa, Mea Maxima Culpa is part of the confiteor or prayer for Catholics or lapsed or defective Catholics like me, in which you can wipe the things you've got wrong or done wrong off the tape and start doing them again. Now, let me explain why that is. I want to talk to you about central banks. I have been looking at central banks this morning, and despite the Fed and despite the best protestations, it looks to me like central banks' balance sheets will finish this year 100% greater than they were before the pandemic crisis. And that is trillions and trillions of dollars of more asset purchases going on around the world, which are, of course, a form of printing money. And that judgment is also cognizant of the good economic performance that we are seeing in almost all the developed countries, and not a few emerging economies, not all by any means, but some. Now, what that tells me is that the famous maxim that there's no use worrying about the past, the future is where we're going to spend the rest of our lives, is a nice maxim, but it's wrong. It does not apply to central bankers. Now, here is the reason I say it does not apply to central bankers. If you were a sane central banker, and there are not many of them, but there are some, and you were to start your functions today without any history behind you, and the world economy was doing what it is doing today, you would not be doing what central banks are doing today, tomorrow, and at least into halfway through next year. You would not be printing that money. You would not be entertaining a policy which is so exceptional in terms of the intervention of central banks in financing governments, in pumping liquidity into the system. Why wouldn't you be doing that? You wouldn't be doing that because there is no economic justification for it. The economies in which the big central banks are key players are actually doing very well. So why would you be doing so many exceptional things? Why would you have so many extraordinary policies? And the answer is you would not, because it is not warranted. What actually justifies what central banks are doing is the fact that they have done so much they cannot stop. If they were to stop, they would undoubtedly produce not a tantrum, they would produce a collapse. So the key point to remember is that what central banks are doing and what they are going to go on doing is the legacy of history and not the necessity of economics as they are unfolding in the major economies today. All of which brings me to the Fed. Now, the Fed last week published its famous dots on forecast interest rates. That's Fed fund rates, the rates that they control, and its economic projections, and they are inconsistent. The economic projections showed that everything would be fine, inflation would be transient, any slight bubble qualities which one can see in the economy this year will disappear by next year. And employment, unemployment, inflation, and growth will all converge with a happy medium, which can be called around about 2% for almost everything in the universe. That's the Fed. But the median value of the forecast for federal funds rates shifted and became 2 hikes in 2023. And that, to say the least, roiled markets. The reason it roiled markets is because the Fed previously has said there is so much damage from COVID, we don't need to do anything. Not now, not for the foreseeable future. And then suddenly they stepped into the picture and did something. They didn't do anything. They actually, in the phrase talking about tightening, they actually cut out one of the talkings. So it became a slight step closer to reality in terms of future policy, but not until 2023. Now, the impact on markets was really very interesting, and that's why this video is called Mea Culpa. It was completely contradictory like the Fed's statement, because the movement of the dots did not correspond to the longer-term economic forecast, but contradictory in this fact. As the Fed talking about tightening policy, which basically means raising interest rates on long-term bonds, called the yield, actually fell, and interest rates on short-term bonds, 2-year treasuries, rose. But if you look at 10-year bonds, 10-year treasuries, or 30-year treasuries, the yields were actually lower on Monday than they were on Friday, and the yields on 2-year bonds were actually higher. This is called flattening of the yield curve, where you get paid less for owning long-term bonds, and you get paid more for owning short-term bonds. That's called flattening of the yield curve. So that was one contrary reaction. Why would long-term rates go down if short-term rates went up? The second reaction was that equity markets went down and stayed down. And the third effect on capital markets was the dollar went up and stayed up. And practically every currency, including emerging market currencies, the euro, my favorite, the Norwegian kroner, actually fell, and fell quite dramatically. The euro down to, say, 118 something from 120 something. So we're talking about 4 to 5% devaluations of major currencies against the US dollar. Of all these forecasts, I only got one right, which was that equity markets went down and stayed down. And the reason for that is because the slightest whiff of inflation increases the discount factor in equity markets and makes future profits or future dividends worth less today, for 3 reasons. Number one, the risk of higher inflation reduces real earnings growth. Number two, higher inflation may increase cyclicality. And number three, the discount factor itself increases to reflect the risk of higher inflation and the risk of greater cyclicality. So obviously, the present value of markets, that is the current level of markets as a discounting mechanism for future profits, was going to lead to a fall in equities, and that turned out to be true. Thereafter, everything turned out to be wrong. The reason long-term bond yields fell and short-term bond yields rose in the United States, they were pretty well unaffected elsewhere, is because investors actually were surprised by the Fed. Though it is kind of surprising that one could possibly be surprised that the central bank's next move would be to tightening. So they rushed into shorting short-term treasuries. So the 2-year treasuries got shorted. And most investors need a long side to correspond to that short position. So that long side was to buy long-term treasuries, 10, 20, 30 years. And that's why the yields moved in contrary directions and the yield curve flattened. Incidentally, also implicit in buying, going long-term treasuries is the assumption that any tightening by the Fed will get rid of any inflationary effects and the whole party will end happily, and long-term bond yields should therefore actually fall as the Fed tightens, because in the best circumstances, there will be less inflation down the road, and in the worst circumstances, the Fed will actually tip a grossly over-indebted economy, which is the US economy and most of the global economies, certainly among the developed countries, it will tip them into deflation and recession. So that's why the bond markets went that way. The second thing I got totally wrong was the movement in currencies. The assumption that I had been working on was that the US dollar had been behaving well, but would now start to resume its long-term trend decline. The reason it would do that is because Bidenomics, the economic policies of this administration, are incurring such large deficits that they will boost the current account deficit, increase the financing deficit of the United States. So domestic savings fall because the budget deficits rise and debts rise, and the external deficit rises because a fall in domestic savings automatically increases external deficits. So I assumed it would take a weaker dollar, in which the next move might be up, so investors would get paid more on a currency adjusted basis if they were foreign. And at the same time, higher interest rates would be necessary to finance an increasing external deficit of the United States. So higher interest rates, long and short, and a weaker currency. That didn't turn out to be the case. And the reason it didn't turn out to be the case is something we want to keep in mind, because it will affect the future value of portfolios. It is that international investors at this point in time, not forever, but right now and for, let's say, the next 2, 3, 4 months, are only interested in the fact that the US economy is the only economy where interest rates could tighten and where you get paid a non-negative yield, you get paid a real yield at the present time. And that by getting paid more, because growth is strong and because the Fed might possibly tighten, then that's reason enough to own the US dollar. So what people did was to say, I'm only interested in relative interest rates. The US is likely to have a relative tightening of monetary policy when compared to Japan or Europe or most other places. Therefore, I'm going to own the US dollar right now because I'm going to get a higher interest rate yield on that investment. I don't think that will last. In fact, I don't think much of the things that I got wrong will prove durable. I suspect that long-term interest rates in the United States are largely technical. People going short the short end, going long the long end. And once that washes out, it will be clear that the current yields on long-term bonds in the United States are way below inflation. And that is not sustainable. Neither is it sustainable that long-term bond yields in the United States should be below the nominal rate in GDP. That nominal rate in GDP is a good proxy for the return on capital in that and the cost of capital in that economy. So I think long-term rates will start to rise again. Secondly, I think the twin deficit theory of long-term structural weakness in the US dollar will reassert themselves. But for the moment, all I've got to say is mea culpa, mea maxima culpa, right on the equity markets, wrong on currencies, and wrong on the initial reaction of bond markets to Fed tightening.